Okay, hello ladies and gentlemen, and welcome to this webinar brought to you by CITYINDEX. This is Best Indicators for Technical Trading, and this is part of an ongoing series of Wednesday webinars that I'm going to be giving all about educational subjects on how to trade the markets. Last week was our first, and we talked about just an introduction to financial trading, and I'm going to go over what we're going to talk about in the upcoming weeks, but today, again, we're going to be talking about the best indicators from my point of view for technical trading. I'm going to be showing you, I'm going to be giving you a description of each of these indicators, and then I'm going to be showing you them on my live charts, just so you could take a look at exactly how I use them in practice. Okay, so my name again is James Chen. I am the Chief Technical Strategist with CITYINDEX Group, and let's get started real quick here. Okay, just first a quick disclaimer. Financial trading carries a high level of risk to your capital with the possibility of losing more than your initial investment and may not be suitable for all investors. Ensure that you fully understand the risks involved and seek investment advice if necessary. If you have any questions during the course of this webinar, please feel free to type them into the questions window, and I'll try to get to as many as I can. Okay, so let's get started really quickly. Okay, just very quickly about me. I'm not going to go over this, take too much time to go over this. My name, again, is James Chen, the Chief Technical Strategist at CITYINDEX Group, which spans several different areas of the world. And what I do is I trade the markets on a daily basis, whether it's, as I mentioned last time, the currency markets as well as the indices and stocks and shares and commodities and pretty much everything that we offer. Also, I analyze the markets. You could find my analysis on our website at cityindex.co.uk, and I also educate much like I'm doing today. And just I've been trading for quite some time, over 15 years, using primarily technical analysis. So my educational webinars will be geared, more towards the technical side as opposed to the fundamental side. But I think a lot of you have interest in the technical side. That's not to say that I don't use fundamentals. I do, but in terms of the day-to-day trading, I'm using primarily technical analysis. Okay, so that's very quickly about me. You could read a bunch of this, when you have time. This is going to be recorded, much like last week's webinar was recorded and posted on our website. Okay, so just very quickly about the upcoming webinars. Last week, as I mentioned, we did Introduction to Trading Currencies, Indices, Commodities, and Shares, and I gave the characteristics and the advantages and benefits or the disadvantages of trading any of these different markets. This week, as I mentioned, we're doing Best Indicators for Technical Trading. I'm going to qualify that title in a second because this is a pretty grand title, but I'm going to qualify that in a minute. How to interpret the most common chart patterns. I'm going to do that next week, next Wednesday, same time, talking about the different chart patterns that you see. Often, if you take a look at my analysis, you'll see it all over my charts. These different chart patterns. And then we're going to be talking about using multiple time frames when analyzing charts, and I do that very, very often. It just makes a lot of sense. And then we're going to be talking about planning high probability trade entries. Okay, so that's going to be a very good one. And then we're going to be talking about exits in terms of setting stop losses and profit targets. And then after that, we're going to go through the different emotional aspects and trading psychology aspects of trading. And then on the 8th week, we're going to be talking about trading plan discipline. Okay, and that's going to be very, very important. So that's basically the timeline or the subjects for the next 7 weeks. Now, this is, as I mentioned, this is an ongoing webinar series, so we're going to keep going after that. It's just I have these topics for the first 8 weeks. Okay, so let's get started real quick. Let's talk about the indicators. Now, I said I was going to qualify that title, the best indicators for technical trading. Now, first of all, I just want to say that I'm not primarily an indicator trader, which means that I'm not going to take one indicator and I'm not going to say it's, this is the holy grail of trading. I'm going to be using it and it's going to be, giving me profits just by using this one indicator. I'm not that type of a trader. You may be. I don't think it really works that way, okay? In terms of indicators, and when we talk about indicators, we're talking about those mechanical indicators that I'm going to show you in a minute that reside on your chart, usually underneath your chart or overlaid on top of your price chart, okay? So these could be moving averages, it could be stochastics, it could be Bollinger Bands or what have you. I'm going to go through all these in a minute. But that being said, no one indicator or tool is the be-all, end-all of trading, and I really want you to know that before I get started here. What I use these indicators for is to give myself an edge in trading. Okay, so I'm going to be using a lot of different tools, but these mechanical indicators are just to give me an additional edge. What I want to do in my trading, and what I have been doing for many years, is that I put together all of my different edges, which includes these indicators, which also includes support and resistance, trends, also the fundamentals, also all types of different tools that I use to put together to give me the best possible probability of being successful, of being profitable. Okay, and this goes back to what I often talk about in terms of confluence. And confluence is simply an agreement or putting together of the different tools, the different trading tools that you have, putting them together, and if they're all telling you pretty much the same thing, as in, for example, I'd like to go long on, or I'd like to go short on euro dollar. Okay, to give a more concrete example, I want to go short on the euro dollar. A lot of things are telling me that. Okay, at this point. Not only my indicators, but also the trend that has been around for quite some time, the downtrend that has been around, also the chart patterns that I'm seeing, the indicators that I'm looking at, the moving averages, also the fundamentals. Okay, so all of these put together, along with different time frames, are telling me that this is looking pretty bearish, and I'm going to be looking for an opportunity to go short. Okay, same thing to the upside. Okay, so once again, indicators are not the end-all, be-all. They're simply tools to help you get as high a probability outlook in your trading as possible. Okay, that being said, let's go to the indicators that I use. First of all, moving averages. Now, am I going to be using? A lot of people when they first start trading, they look at moving averages and they look at moving average crossovers, which are basically one moving average, a short-term moving average, crossing over a longer-term moving average. And, it looks like a good signal. So let's say a shorter-term moving average crosses above a longer-term moving average, and that's a signal to go long. Okay, by the same token, going the shorter-term moving average crossing below a longer-term moving average could be a signal to go short. And if you look at the charts, it sometimes works. It sometimes works. And then people think, okay, this is if this works, then I'm just going to use this. I'm going to make my trading so simple that I'm just going to be looking at crossovers of moving averages. Well, unfortunately, over the long run, it doesn't really work as well as you might think, okay? Because you're going to get what's called whipsaw, okay? So where the moving averages are crossing up and down, you're taking all these signals and you're losing a lot of money in the process, okay? So that's exactly what we don't want to do. That's why I'm looking for several different indicators, several different indications, several different tools that I have to give me the best possible probability. That being said, why do I use moving averages? Well, moving averages can be very good in many ways in showing the support and resistance and in showing the trend. Okay, I just have to, just to give you, one example here. We take a look at this is a Aussie dollar chart. Actually, let me go and take a look at another chart. Let's take a look at the pound dollar chart. Okay, so I wrote about this today. Now, if we take a look at this is a daily chart of pound dollar. If we take a look at this trend line here that was broken recently, but price action on pound dollar is coming back down. But if we take a look at this trend line we have here, and we also take a look at, it may be hard to see for you, But if you take a look here at the 50-day moving average, which is one of the ones that I usually use a 200-day, a 100-day, and a 50-day. On this particular chart, I happen to have the 200-day and the 50-day. So if you take a look here, this works very well as a resistance, okay, in this downtrend. If it was a more severe, a sharper downtrend, then we could look at the 20-day moving average. But for this particular downtrend, this 50-day moving average, this 50-period moving average, works very, very well as resistance, okay, and it has worked very well as resistance for along the course of this downtrend, okay, until it's broken out of to the upside. Now, as we can see here, I have the 152.50 level as support on pound dollar. I'm fully expecting, or at least I think, that price action is going to fall further down, and we're going to have a continuation of the downtrend in pound dollar. Okay, but that being said, what's most important about this is that I have support at 152.50, so that was my target this morning. Okay, 152.50, and I'm looking for further downside below there. Now, 152.50 is also where this moving average is. Okay, so that's also acting as support. So resistance becomes support, becomes resistance, becomes support, and so on and so forth. Okay, that's one of the tenets of technical analysis. So here we have this acting now as support where originally it acted as resistance. But that being said, again, I'm looking for a continuation of the downtrend in pound dollar to move below 152.50. But as we can see here, the point is that this is acting very well as resistance. If we take a look at euro dollar, same thing here. Okay, euro dollar is acting. Is also, this 50-day moving average is also acting as a sort of a resistance here. It acted at least 2, 3, 4 times here, maybe 5 times right here, as resistance in this downtrend. Okay. Now, just keep in mind, first of all, that I am using daily charts. I'm showing you daily charts. I do most of my analysis on daily charts. Okay, but I know most of you are using much shorter term charts, like maybe the 5-minute chart or the 30-minute chart, or even less than that, even smaller than that. These indicators all conform to your time frame, whatever time frame you're using. So I happen to be using the time frame of the daily time frame here, and this is working very well as resistance. Now, if we look on a shorter term time frame, these same moving averages may also work as resistance. So this really these indicators really go across time frames. Okay, so what I'm showing you now on the daily chart, could very well or should very well apply to the shorter term charts. Okay, so anyway, here we have the downtrend here. Let me take a look again at the Aussie dollar, and if we take a look at the Aussie dollar, it may be a little bit hard to see. It's very hard to see actually, but this green line here, I have the Bollinger Bands here because I'm going to show that in a second, but if you take a look here, we could see that this line is acting very well as resistance, and it continues to act as resistance within this downtrend on the Australian dollar against the U.S. dollar. Okay, so that's one of the tools that I use in terms of the indicators. Chris asks, how do you work out the moving averages? How do I work them out? I'm not sure what that means, but basically I have several different moving averages that I use, and several different moving averages that I use on pretty much all of the markets that I'm trading, and this includes the 200-day, the 200 period, the 100 period, and the 50 period. Also, sometimes the 20 period if it's a very steep trend. Okay, so those are the ones I use. Let me see here. Take a question. Mansuk asks, what time frame do you use to enter? Okay, yeah, that's a great question. A lot of people ask me that. What time frame do I use to enter into trades? And it'll vary according to the strategy I'm using. But generally speaking, what I'm going to be looking at is the daily chart for the trend, for the overall trend, and then I'm going to be drilling down into the shorter term charts, most notably the 1 hour chart, and then sometimes below there into the for example, a 5-minute chart. If I'm trading on a very short term time frame, short-term time frame, I'll go all the way down to the 5-minute chart, but usually not. Usually I stick to a longer-term time frame. I'm not a day trader. I'm more of a swing and position trader, which means that I'm looking at longer-term time frames. Paul, how do you use the same periods on shorter time frames? I do. Okay, I do use the same periods on shorter-term time frames. Now, it's because it's all relative. Okay, so if you look at the let's look at the 50-day moving average again. Okay, the 50-day moving average on the daily chart is 50 days. The 50-period moving average on the 5-minute chart is 50 5-minute periods. Okay, so all it is it's giving you what the trend is and what the recent trend is, and it's averaging out the last X number of periods. Okay. It's giving you the last X number of periods. So again, if you're on a half-hour chart, if you're on a 30-minute chart, it's going to, and you're using the 50-period moving average, it's going to give you the last 50 half hours. Okay, there are a bunch of questions here. I'll try to get to them in a minute. Let me just, oops, I opened that by accident. Okay, let me just go back to the moving averages. So basically, I'm using these as support and resistance, and I'm using them as trend indicators, and they do remarkably well if you take a look at the charts that I just showed you. Okay, so the different currency pairs I just showed you, that it outlines the trend very well. Okay, and again, I'm using mainly the simple moving average, but you could also use what's called the exponential moving average, or EMA. They're all on your charts, okay? So you could pick and choose whatever you want. And there's a small difference, a very small difference between the SMA and the EMA. The big difference being that the simple moving average measures the last X number of periods of price on an equal basis, whereas an exponential moving average weights it more on most recent price action. Okay, if you're not sure what that means, it doesn't really matter. The simple moving average and exponential moving average will not give you a huge difference unless you are trading crossovers. Okay, which I don't really recommend doing. Okay, common periods, like I mentioned, 20, 50, 100, and 200. Now, with moving averages, you have to watch out about the lag and the whipsaw. Okay, so what does that mean? Every indicator that I'm going to show you lags price, okay? So keep that in mind. It lags price. Price moves first, and then these indicators move after it. What does that mean? These indicators are all mathematical derivatives of price, okay? A moving average is taking an average of the last X number of periods, but it's lagging the price. It's going to move after price does. Now, that's important. Okay, and everyone says, a lot of people say, okay, so if these are lagging, then how are they useful? Well, they still are useful. Just because they're lagging does not mean they're useful, because oftentimes, if you look at price alone, it's very hard to get a good picture of what the market's doing, where you need other tools to give you a better picture. Okay, now. Just because of the lag does not mean that it's useless and it's not important. Okay, so I'm well aware that there's a lag in these indicators, but I use them nonetheless because they do help me. Okay, let's get to some questions. Babalola says, if you look at a 4-hour chart, does that mean you are looking to hold your position for 4 hours? No, that does not. Okay, that usually does not. What that means is, okay, so you're basically saying a 4-hour chart. That means each bar or each bar or candlestick, as we see here, is worth 4 hours. Okay, so that's 4 hours in time. Now, this happens to be a daily chart, but just to go to your example, that's 4 hours in time. Now, that does not mean I'm going to be holding it for only 4 hours. Okay, I'm not going to be looking at a 4-hour bar and then trading that 4-hour bar just for the span of that bar. No, I'm going to be looking at if I'm looking at a 4-hour chart, I'm probably going to be holding a position for significantly longer than 4 hours. Okay, same thing on a 5-minute chart. If I'm trading a 5-minute chart, I'm not going to be holding just for 5 minutes. Okay, so that's why people like to. A lot of very short-term traders like to go to like very, very small small time frames. So short time frames. and then they'll trade for a few minutes or sometimes even a few seconds. Okay, good question there, Ludovico. How long do you typically wait to confirm a breakout and act on that using a daily chart? Okay, I don't often trade directly from the daily chart, as I mentioned. But what I look for, and this is going to be a subject of another webinar, but what I look for on entries is usually it is a breakout, okay? But usually it's going to be on a shorter term time frame, like the 1 hour chart, okay, or at most the 4 hour chart. But oftentimes I'll go under that. But I'm going to be looking for a breakout of the bar if everything else lines up. Okay. Jean or Jean, what's the difference between different indicators? Is there any possibility to calculate the two extremes of any pairs? What's the difference between different indicators? Okay, that goes a little bit beyond the scope of this. The difference between different indicators, they're all mathematical differences. So there are going to be differences in the way that the indicators are mathematically derived. The calculated two extremes. I'm not sure I understand that. If you could clarify that. Kuldip, how do you find trade to short of long? Point of entry of that trade. Short or long. How do you find trade to short or long? Okay, point of entry of that trade. Okay, well that's all about using my tools. So how do I find an entry and whether to go short or long? I'm going to be looking at several different things. Okay, that goes a little bit beyond the scope of this webinar, but basically what it is I'm looking for trend. Okay, I'm looking for whatever time frame the trend is on. I'm looking for the trend, and then I'm looking for support and resistance levels, and then I'm using my indicators that I'm showing you today, and then I'm using chart patterns. Okay, and I'm also using fundamentals to give me an overall picture. So basically, that's how I find whether I'm going to go long or short. I'm using the tools available to me, and if those tools are agreeing with each other, then for me, it makes for a higher probability trade and a better chance of making money on that trade. Sanjay, I've seen many users using 10 EMA with 20 SMA. How do you see this? I don't see any point in using one EMA and the other an SMA. But they may have a crossover strategy. That looks like it may be a crossover strategy, okay, which could very well work for some people. But again, I'm not a crossover trader. I'm not a moving average crossover trader. Why? Because I think there's too much whipsaw. I've tried it many years ago. I tried it, and I've tried it on a longer term basis to see if it works. For me, it works during some periods, during very trending periods. Other times, you get whipsawed to death, and then you lose a lot of money. So for me, not a very high probability trade. Maher, does New York closing candlesticks give a better indicator as some traders? Not necessarily. Okay, the closing candlesticks does not make a huge difference. Okay, it's important to use this as a better indicator. No, it really doesn't. For me, it really doesn't make a huge difference unless you are trading on the daily chart. But really, it's not a huge difference. Ludovico, can you identify long-term price consolidation corkscrewing with moving averages? Yeah, I mean that's basically what it is. If a moving average is moving sideways, then you could be. I mean, if you take a look here, if you take a look over here, you could see that the 50. It's very hard to see here, but if you take a look, I think you could see over here where the Aussie dollar was just consolidating. You could see that the moving average was relatively flat. Okay, again, this is lagging price, but it's giving you an indication that there is consolidation and perhaps continued consolidation. Now, how do you know when this consolidation is going to be broken? We use our other tools. Okay, we use our other tools that I'm going to show you in a moment. Okay, Mohammed, sorry, could you explain whipsaw? Okay. Whipsaw, yeah, whipsaw. Okay, what is whipsaw? Let me try to show you right now what whipsaw is. If I could get this to work. Okay. Whipsaw is sort of like this thing. I could show you better examples, but let me see. These two moving averages that I'm using are pretty long. I'm using the 200 and the 50, so I can't show you a lot of whipsaw, but basically it would look like this, where it's very choppy, okay? And if you have shorter-term moving averages, I'm not going to put them on my chart right now, but if you have shorter-term moving averages, you'll see that boom, 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 it's going to keep crossing over, and then you're going to be whipsawed to death, okay? So that's basically what it means. It's you're going to see a crossover, crossover. You're going to be taking all of these signals because if you have a strategy like that, you have to take all the signals. Okay, because what if you didn't take a signal that turned out to be the big money maker? So you have to take all these signals. But if you're taking all these signals during this time, okay, you're not going to be making much money. In fact, you're going to be losing a lot of money. Okay. Now, if this happens, if you catch this long downtrend here, then you're doing well. But before you get to that long downtrend, you got to get through this, and by then you could have blown out your account. Okay. Nima, let me see. You have only talked about MAs until now. Yeah, I'm sorry. And the webinar is only 30 minutes. Answering all the questions takes so much time. Okay, yeah, I'm sorry, Nima. Let's move forward real quick. Okay, Bollinger Bands. Bollinger Bands are here we see the Bollinger Bands. What are they? They're a measure of volatility. Okay, a measure of volatility. Here we have this volatility. It's what Bollinger Bands do is that there's a moving average in the middle, and then there's an upper band and a lower band. And these upper bands and lower bands squeeze together when there's low volatility, and they expand when there's high volatility. Okay, so how do you use this? Let's take a look. So you take a look at Bollinger Bands here. Okay, so during times of consolidation, we have relatively flat Bollinger Bands where you could look towards trading short when it gets to the top, and then trading long when it gets to the bottom. That being said, it's also not the greatest strategy because you need to really use everything in conjunction, because what happens when you get to a place like here, okay, where it goes below the Bollinger Bands and it keeps moving down. That's why, for me, Bollinger Bands are just an adjunct tool. So if you take a look here, okay, so we have an established trend here on Aussie dollar. Okay, this is way back in the day, but just to show you, we have an established trend established sideways trading range on Aussie dollar. Now we have strong resistance up here. Okay, this is about, let me take a look. This is about 106 level. We have very strong resistance up there. Now we have what's called a shooting star candle. Okay, and also we see price has hit the top of the Bollinger Bands. Okay, you use that in conjunction with each other, and then also we have a cross down, which I'm going to talk about in a second. The cross down on the stochastics right here. Okay, so you have those four different things telling you that maybe this is going to go short. And therefore, you could get into a possible short position, and then you have your risk management or your stop loss to protect you. But this looks like a very good opportunity because I have four different tools telling me that something is going to happen, okay, or something could happen. And in fact, it does happen. You've got a nice run down here on the daily chart, okay. So this was the stochastics down here. This is the shooting star candle. This is key resistance up here. This is the top of the Bollinger Bands. Okay. So that being said, Bollinger Bands, is it a great indicator? It can help a lot. Okay. It can help a lot. Actually, I've talked with John Bollinger, who created these bands, and basically what he says is that he doesn't use it as a trading range. Okay, a trading range tool. He uses it more as a trend tool to, if you see something like this. So, for example, if we take a look at this, I know it's very hard to see, and I apologize for that, but if you take a look here, you have what's called the Bollinger Band squeeze, okay? Again, with low volatility, okay? So it squeezes into low volatility, and then it expands. And that expansion can be used to look for a breakout of the consolidation, okay? So we have very tight Bollinger Bands, and then we have an expansion, and then there's where the breakout occurred, okay? So that's Bollinger Bands. So it can be used in range trading situations as well as trending situations like this. Okay, now let me get to one of my favorites, the oscillators. Okay, Babalola asks, how do you know the right upper and lower limit for the bands? Okay, that's a good question as well. How do you know what the how to set them? Well, I'm using what's the common setting, which is the 20-day. The 20-period moving average, and then let's take a look at this real quick here. The 20 period moving average in the middle, and then around it is 2 standard deviations. Okay, so 2 standard deviations away from it is this. So again, it's a measure of volatility. So I'm just using the 20 period moving average and 2 standard deviations. Okay, so let's talk about oscillators. Now this is one of my favorite topics, and people bad talk oscillators all the time because they think that, again, it's a lagging they're lagging indicators and they can't tell you much. But I would beg to differ on that. I use oscillators a lot as adjunct tools, as the tools that provide me support for my trades. Okay, so not only am I going to be looking at the trend and support and resistance, I'm also going to be looking very closely at these oscillators. But I don't use these oscillators, and when I say oscillators, what I mean is like stochastics, MACD, RSI, CCI. There are a bunch of them. Okay, I only use a handful, if that many. I'll often just use the stochastics. Okay, and I'll show you why in a second. But basically, what is an oscillator? What is an oscillator? Well, it's a bounded indicator, okay? And basically, what it bounded meaning that if price keeps going up, the oscillator will not keep going up, okay? It's going to stay below the bound, okay? Boundary. And if price keeps going down, the oscillator's not going to keep going down. It's going to be staying above the lower boundary. But so how is it important? Well, oscillators are basically measures of momentum, okay? And they give you overbought and oversold indications, okay, and potential turning points. Now, what I use them for is I use oscillators to give me potential turning points where a pullback goes back into the trend, okay? And I'll show you that in a minute. But basically, what I'm using this for, again, is I'm waiting for an emergence from overbought or oversold. I'm not looking for the oscillator to go into overbought or oversold. I'm looking for it to emerge out of. Why is that? Okay, and if I'm not making any sense to you, please feel free to ask questions. But basically, let me show you exactly what I mean. Okay, just to go back to this chart because it has all of my indicators on it. Let's make this bigger. Oops, let's do this real quick. Okay, this is my stochastics, okay? First, let me just go through stochastics. Okay, so this is stochastics, and as you can see here, this is on the same chart. Now, if you could see my mouse pointer, okay? If you could see my mouse pointer, you could see that I'm not looking for the oscillator to go into overbought or oversold. Okay, what is the level for overbought or oversold? Here. Okay, usually on the stochastics, as I'm showing you now, the overbought is 80. Okay, the oversold is 20. Okay, and but you could easily change that. But those are the standard settings. On on RSI, it's going to be different. I believe on the default RSI, it's going to be 30 and 70. Okay, 30 is oversold, 70 is overbought. Now, if you take a look at this, what I'm not looking for is right here. Okay, I'm not looking for it to enter into overbought. A lot of people say it enters into overbought, and then and then that means that it's overbought and you should sell it. Okay, or if it enters into oversold, that means it's oversold and you should sell and you should buy it. You should buy it. Okay, now that's exactly the opposite way of what I use it, of how I use it. Now, what I'm looking for is not when it enters into overbought, rather when it exits from overbought. Okay, if you take a look here, when it exits from overbought, you could tell right here. Once it exits, which means once it goes below the 80 level in stochastics, that's a pretty early signal. If you take a look here, take a look at this red line. Usually I take off this dotted line. Okay, I use the %K on stochastics, which means I'm looking for this to happen. Okay, I'm looking for it to cross below overbought, and then I'm looking for it to short. Okay. Now, if we take a look at, and again, this is, I'm not going to be using this in isolation. I'm not just going to be saying, oh, it's exiting, it's going below overbought, so that means I'm going to sell it, and that's all I'm looking at. No, absolutely not. I'm looking at a bunch of other different things too. But this is helping me. This is giving me another indication of perhaps, we're seeing this. Now, I don't usually use this setting. I forget the setting I use. This is the default setting, 1433, and this is giving you some false signals. But I'm going to remember. I'm going to take a look for next time. I'll tell you exactly what settings I use for stochastics. But this one, as you can see here, at major turning points, you see that, as we can see here, when it emerges from sold, I'm looking to go long. And as you can see, this is a very early signal as well, okay? This is an early signal as well. So when it emerges, I'm looking to go long. Now, why else am I looking to go long here? Okay? Well, we've got a inverted head and shoulders here. Okay, we've got the neckline here, and I'm going to be talking about head and shoulders in the next webinar next week on chart patterns. But basically, what I'm looking here is I'm looking at several different things. Again, I'm all about confluence. Several different things coming together to show me this. Okay, so we see that there's a breakout. There's a breakout above this neckline, and prior to that, there was a turn on the stochastics where it emerges above oversold. Okay, so I'm getting two different signals there, and I have this inverted head and shoulders that's giving me some clue as maybe this whole thing is turning back around, going to the upside again, and in fact it does happen, and there we have it. Okay, so I'm not just looking at this. I'm not just looking at this. I'm not just looking at this. I'm looking at the big picture, but this is helping me a lot. Okay, let's go back here. So that's stochastics. Basically, again, bounded indicator, I'm looking for emergence from overbought or oversold. Now, what about the MACD? Okay, what about MACD? Same, very similar idea here. Okay, MACD is more of a trending indicator. So it's so what I'm looking at most of all on the MACD is what's called the histogram. Okay, so. And bear in mind, I'm not using both of these at the same time. Okay, I'm going to use one or the other. I'm not going to clutter my charts with. I cluttered it today just to show you, but I'm not going to be cluttering my charts with 10 different indicators. I'm using at most one or two. Okay, so here on MACD, what we're looking at here is what I'm usually looking at is what's called a histogram, which is these little mountains and inverted mountains. Okay, so peaks and troughs. So what I'm looking for is a cross of the zero line on MACD, okay? So that's showing me momentum to one side or the other, okay? Now, if you take a look at this, and if you take every cross that occurs, you make a lot of money, but, oftentimes you'll also get that lag or whipsaw. That's why I do not recommend taking this one indicator and just using it this way, crossing over the zero line. But that being said, it's very helpful for me because it shows me when the momentum has changed. So you take a look at the trend momentum. So you take a look at MACD. What this is when it crosses over is usually a change in momentum. So here it stays below the zero line and then it crosses above. Okay, it crosses above. And then that's when the momentum has changed. And that occurs right when the stochastics crossed above and also right when there was a break above this neckline on the head and shoulders, okay? And here, same thing, okay? When this happened a little bit later, but it crossed over to the downside, and then it gives you, it gives you some indication that the momentum is changing to the downside. Okay, here again we see the momentum changing to the upside. This is also a little bit late, but it's changing to the upside. Now again, if you use a shorter term time frame, just you could just pretend this is a 30-minute chart or a 5-minute chart or whatever you use. It's essentially the same thing. Okay, there is a lot more up and down chop on the shorter term time frames usually, but what we're looking at here is essentially the same. So you put this indicator on any different time frame, you'll see essentially the same thing where it's giving you changes in momentum. Okay, so here you see a change in momentum to the upside. Okay, now here is when it doesn't work so well. Okay, so here you got it goes down. This is the whipsaw I was talking about. It goes down. Okay, then it goes up. Then it goes down. Okay, then it goes down. But now we see here that the momentum is to the downside here. Okay, it continues to the downside and continues as such. Okay, and it's continuing low. Okay, so I'm bearish on for the time being. I continue to be bearish on Aussie dollar, not just because of this, not just because of stochastics, not just because of this trend line, not just because of this moving average, and not just because of everything else I see here, but all put together. Okay, so I'm looking to the downside on Aussie dollar. If you didn't know that already. Okay, let's go back, and we talked about MACD, stochastics, average true range, another indicator of volatility. Okay, so let's open that real quick. Now, what is ATR? Average true range. Okay, what is average true range? What average true range is it gives you the range between low and high, the number of points between low and high, averaged out for the last X periods. Okay, the default on most platforms that you use, including Advantage Trader, Advantage Web, will be 14. Okay, 14, the past 14 periods. If you're on a daily chart, past 14 days. Okay, so here, as we can see, very low volatility. When it's going, the range, all this is range is volatility, okay? So we see during this sideways move on Aussie dollar back then, okay, there was a lot of very low volatility, okay? And what are we looking for? A volatility breakout, okay? So how could you use ATR? You could use it perhaps in this way, okay? So if you see prolonged low volatility, okay, if you look for a volatility breakout, it breaks out above the peaks of these last several peaks. Once that occurs, that's the beginning of the downtrend. Okay, I didn't actually use it in this way, but this is a very good way to use it. I mean, I didn't catch it. I didn't have the ATR, when this first began, but I used other methods, including this breakdown of support, breakdown below support. Okay, so it broke down below support. And here we have a breakout of volatility. It's not directional. ATR is not directional. It doesn't tell you where price is going. All it's telling you is that there's an increase or a decrease in volatility. And here we see the Bollinger Band squeeze. That's telling you there's the squeeze and then the expansion, and that's telling you there's a volatility breakout. The ATR is showing you there's a volatility breakout. You could see the breakdown below this support line. That's showing you there's a breakout. Okay, that's actually what I use, this breakdown below support. Okay, and then I saw it confirmed, and then I looked to get into the trade. Okay, so again, you use all the tools at your disposal, all the indicators, all the chart patterns, all the support and resistance, the trend, etc. You use it all together, and that's how you make a higher probability trade. Okay, so that's basically ATR. Very simple. We see low volatility right here, okay, low volatility, and then we see a breakout, okay, a breakout into higher volatility right around, here, wherever you want to look at it, a breakout, higher volatility. We also see somewhat of a squeeze here. We got a further downside move, and looking to go with the trend. Again, I am a trend trader, so I'm looking to go with the trend. Right now, I continue to look to go towards the trend. Right now, we are in a rather low volatility or a decreased volatility environment on Aussie dollar, but I am looking for increased volatility, looking perhaps to the downside. Okay, not perhaps. I am looking for a downtrend move to continue this downtrend. If it doesn't happen, that's fine, okay? But I'm looking for opportunities to get into another short on a breakout to look for further downside moves on Aussie dollar, in this case, just as a side note, towards the 75 level. Okay, I'm looking towards 75 on Aussie dollar. Okay, so that's average true range. Okay, so those are the main indicators I use. Again, I'm not a huge indicator trader, but these are very, very useful for what I do. Okay, so I'm using moving averages. I'm using, to a more limited extent, I'm using Bollinger Bands, and I'm using the oscillators definitely, including MACD and stochastics, and I'm definitely using ATR, average true range. Okay, now the non-indicators. I only use a handful of indicators, but the non-indicators I use will include Fibonacci ratios, and this is only a non-indicator because it's not what's classically defined as a mathematically derived mechanical indicator. So I'm going to be using Fibonacci ratios. It's not an indicator, but it's another thing that I use, okay? And then, of course, I use the trend, and I use trend lines, and I use moving averages to define the trend, okay? And I use support and resistance. Again, not an indicator, but among the most important things you could possibly use in your trading, support and resistance, okay? And this is going to be a subject for another webinar. Okay, and then I use candlestick patterns. As I just showed you on the Aussie dollar, I showed the shooting star. Okay, there was a shooting star up there, and then a hammer. These are among the two most important candlestick patterns that I use. Okay, so the hammer and the shooting star. Why? Because they give me a very clear understanding of of potential turning points, a very clear understanding of rejection from support and resistance. Okay, maybe I'm not very clear on that, but if we take a look at the hammer, you take a look at the hammer. If this occurs, if this pattern, this candlestick pattern occurs right at a support level, okay, that means that price action went down and came all the way back up and closed near its highs. That means it got, or that may mean, potentially means it got rejected from support, came back up, and maybe we're looking at more buying pressure. Okay, and perhaps a turn back up in price. Okay, and same thing with the shooting star, but the opposite side. So we see price moving up, and then we see the indicator. We see the candlestick moving all the way up and then coming all the way back down and closing near the lows. It gets rejected. If this occurs near resistance, okay, if it's also confirmed with let's say stochastics. Resistance, a moving average perhaps, a chart pattern, they come all together. Okay, this to me is a high probability short trade. Okay, that means you want to sell. Okay, so that's those are hammers and shooting stars, and I just showed you one. I believe was right here. Okay, so this is it hits a resistance level, it goes up, it forms a shooting star. Okay, and then it plays around a little bit, and then it goes down. Okay. And same thing right here. I know it's hard to see, but same thing right here. This is a hammer candle. It occurs right at support, okay, right at the bottom of the lower limit of the Bollinger Bands, and that to me is a potential signal to that it might be a long. Okay, so again, confluence in your trading. Okay, so well, we already went to the charts. Let me go through a few questions here before I just do a quick review. Okay. Lee, do you not find you get too many signals with the stochastics and that the RSI gives less noise? You get too many. Oh, okay. Do you not find that you get too many signals with the stochastics and that the RSI gives less noise? No, I don't find that, especially with the settings that I use. I don't have it with me right now, but the settings that I use are a little bit longer, so it doesn't give me as many signals as the 1433 on the stochastics would. Okay. RSI I use sometimes too, but essentially when you look at RSI and stochastics, although the mathematical formulas are very different, they're basically saying the same thing. Just like what I just showed you, the MACD and the stochastics showed, similar things. Of course, it's not going to be exactly the same, but similar things in terms of momentum, because all of these, all of these indicators, these oscillators, they lag price and they give indications of momentum. Okay, their mathematical formulas will be different, but but they're very similar. Duncan, do you wait for the K or D or both to cross the 80 or 20% mark? Great question. Okay, Duncan, do you wait for the K or D? Okay, what is the K or D? For those of you who don't know, let me go back to the stochastics here. The K or D. Okay, this is the percent K line, the red one. The dotted black one is percent D. Usually, as I mentioned before, I get rid of the dotted one. I'm looking at percent K. Okay, why? Because if you're trying to pinpoint an entry using stochastics as a helper tool, then it can be confusing because they're gonna cross at slightly different times. So I get rid of the percent D. I'm just using the red one. Lee, look how many times that happened though before it was accurate. Yes. Okay. Lee, I think you were talking about before. In terms of the stochastics. Yeah, that's why I use a longer time frame on my stochastics. Okay, I believe it's like 25. I'll get it for you next time if you if you come by. But it's 25, 10, and 5 or something. Okay, but and I don't happen to remember right now because it's on my other charts. But I've tested a lot, and I've basically set. Kept it on my chart for a long time. That's why I don't remember it. Okay, because basically I've kept it on that same setting, and I don't look at it, look at the setting all the time. I'm looking at the signals that it gives. So yeah, you're right. You see a lot of false signals here. Okay, I mean not a lot, but you see some, a good amount of false signals. Okay, for example, here. Okay, I mean this isn't a really false signal, but you don't have a very nice run there. Let's see. Yeah, I mean, it's not that many false signals. It's not that many false signals. I mean, here you might say is a false signal, but it does go down. But let me see here. Yeah, this one's a false signal. Okay, I mean, it does go down a little bit, but it goes right back up. This is sort of a false signal. Yeah, you do see false signals. With this again, that's why you have to play with the settings. Okay, play with the settings, see what works most of the time, because it's never going to work all the time. See what works most of the time, and then you use that as a very valuable helper tool for you. Again, not as the main tool, as the helper tool. The RSI is more accurate. It may be for you, absolutely. If you think that RSI is more accurate, by all means. I don't happen to. But, and I've used RSI in the past, but I sort of, once I found the stochastics settings that I wanted, it worked a lot of the time, most of the time for me. And, and because I'm not just taking that as the sole signal, I'm putting in conjunction with everything else, it's very valuable. Bablola, stochastics sometimes stays overbought or oversold. What do you do in those instances? Okay, great. Now, sometimes it stays in overbought or oversold. Let me give an example here. Okay, this is why I do not take the, I do not take like going into oversold or going into overbought as a signal, because look, it goes into oversold, and then a lot of people or some people will say, oh, it's oversold, so I'm gonna buy it now. Well, it could stay in oversold for quite some time. Okay, so here it stayed in oversold for a long time as price kept going down. Okay, so that's why that's not a signal for me. It's not a signal for me. Okay, the signal is more when it comes out. Okay, this was a false signal right here. Okay, this was a false signal right here. This one, however, is the signal right here. Okay, but this happens all the time where the oscillator stays in overbought or oversold, and price keeps moving in the same direction and is really not overbought or oversold. Okay, it's only when it emerges that's when you have some indication that perhaps there is a turn in price. Okay. Also, sometimes it acts like it's exiting overbought or oversold, and then it stays there. Okay. Well, you don't. What I do. That's also a good question. What I do is I'm waiting for the actual cross. Okay. and I'm always waiting for the cross to close. I'm not waiting for, I'm not looking for it to pop. I mean, if it pops up before hitting, I'm not anticipating it, basically. I'm not anticipating the cross. I'm looking for the cross to occur, and then I'm going to get in. Yeah, I'm probably going to get in later than if you anticipated the cross, but I'm going to get less false signals, okay? Gurdeep, do you use the moving averages as support and resistance? Yeah, as I mentioned before, that's one of the main ways I use it. Okay, so if we take a look here, as I showed you guys before, maybe you came in a little bit later. Here we have this acting as resistance. Okay, the moving average. As looking the blue, yeah, absolutely, Gurdeep. Yep, I use it as support and resistance. Sanjay, with ATR, how much should it move so that you would get into the trade? Okay, ATR is it's a measure of volatility. Now, one way to use it, as I mentioned before, is as a breakout tool. So we could use breakouts on ATR, much like we could use breakouts on price. So we have resistance here. Let's say, oops. Let's put in something here. We have resistance right here. Okay. Now, you see people talk about breakouts of price. You could go short here on this breakout below support. You could also do it with the ATR. Okay. Well, it could help you. Okay. So if this is a volatility expansion, we could use the breakout here. Now, keep in mind, this doesn't mean go long. Okay. Just because ATR goes up, it's not a directional tool. It's not telling you to go long. It's telling you that there's an expansion in volatility. This could be either long or short. In this case, it's short. Okay, so keep that in mind. A lot of people get confused about that. It's not a tool for direction. It's a tool for volatility. Okay, Dan, hammer and candlestick best on daily time frame or can be used at lower intervals. Hammers and hammers and shooting stars, all intervals, all time intervals, all time frames. Okay, very good at everything, at every time frame you look at. Except maybe the very, very short term. I don't like to use them that much. But then again, I don't really trade the very short term time frames. Ludovico, do you look for long shadows as well? Yes, absolutely. What is a long shadow? All a long shadow is a long line. Okay, a long shadow. So a hammer and shooting star. What are hammers and shooting stars? But long shadows. Okay, long shadows talk about rejection, failure in price to continue in the same direction. Therefore, they're very good in helping you to see that perhaps there's a turning point in price. Bob Lola, I have heard about the black bar indicators that tell you what is going on with the stochastics. Is it effective? I'm not sure what you mean by black bar indicators. Kuldip, why don't you fire email to all of us? Okay, I'm not sure about what, but you could always email me at james.chen@cityindex.com. Gurdeep, are price or Donchian channels useful instead of Bollinger Bands? Yes, they can be very useful. I just don't happen to use them, but they can be very useful. Paul, trick is to have tight stops. Absolutely, Paul. Dan, when reading candlesticks, do you use daily chart or do they give indication of smaller time frames? Smaller time frames. I think I answered the previous question on that. Smaller time frames work very well as well. Gurdeep, do you look for divergence between stochastics and price? Yes. Great question there. Divergence on stochastics and price. Let me show you that before we move on here. Now this is a bit more complicated and complex divergence. Okay, but basically I have stochastics down here. I'm looking for divergence in stochastics, okay, to show me. I'm looking for higher highs in price, lower highs in the momentum indicator, in this case stochastics, and that's giving me, some indication of a potential turn. Again, divergences are not to be used as your sole tool in trading, but they help. Okay, they do help. So if you have, let's say a shooting star here, you got a strong resistance level here. You've got you've got stochastics emerging from overbought. You've got a divergence, and if you don't know what divergence is, it's a big subject, and I'll find some time in the future to talk about it. But if you also have divergence there, very high probability trade. Okay, Very high probability. So I have some divergences there. Good question. Okay, yeah, I think I ran out of time. There are lots and lots of questions here. My email address, again, is James. Let me just, let's go back. Okay, it's right here. james.chen@cityindex.com. Okay, so that's my email address. Feel free to email me at any time, any questions you have. This webinar will be recorded. It's going to be posted probably tomorrow. You know, hopefully next Wednesday, we're going to be talking about chart patterns. So it's going to be an interesting one. And please feel free to attend it. And again, I want to thank all of you for your time today. And I'll see you next time. Thanks a lot.